Hi everyone, in this video I'm gonna go over global intangible low tax income. Very important subject in the international tax space. So let's get right into it. So before we jump into GILTI, let's go over a keyword. Controlled foreign corporation. It is a type of foreign corporation in which US persons own more than 50% of the foreign corporation. And who is subject to GILTI tax? US shareholders of a CFC who each own at least 10%. So let's go over an example. So we have a Hong Kong corporation, a foreign corporation, and we have 3 shareholders. And let's say that all 3 of them are US persons. And let's go over each shareholder. Shareholder 1 is a corporation and has a 70% ownership of the Hong Kong corporation. Shareholder 2 is an individual, has an ownership percentage of 25%, and shareholder 3 is a partnership and has a 5% ownership in the Hong Kong corporation. So when you add up the ownership percentage among all 3 shareholders, it sums up to 100%, which exceeds the 50% threshold to qualify the foreign corporation as a CFC. So the Hong Kong corporation you see here is a CFC. And now we have to determine who among the 3 shareholders we have is subject to GILTI tax. So shareholder 1 has an ownership percentage of 70%. So shareholder 1 is liable for the GILTI tax as it exceeds the 10% ownership requirement. And shareholder 2, just like shareholder 1, exceeds the 10% threshold. So shareholder 2 would have to pay GILTI tax, and shareholder 3 only has a 5% ownership in Hong Kong corporation, which is below the 10% threshold. So shareholder 3 would not be liable for GILTI tax. So let's learn the background and study why GILTI was passed. So prior to Tax Cuts and Jobs Act of 2017, the US did not tax CFC's income until the income was repatriated or sent back to the US. So what did a lot of corporations do? So a US corporation would set up a CFC in a low tax jurisdiction, and the US corporation would shift its IP, intellectual property, to its newly formed CFC, and the US corporations would make royalty payments to the newly formed CFC to have the right to access or use the IP. So what does that do? The US corporation is artificially creating expenses to reduce its taxable income, and in doing so the US corporation is shifting its profits overseas where profits will be taxed at a lower rate. So let's go over the tax benefits of engaging in such international tax planning. Scenario 1, the US corporation does not have a CFC. US corporation has a taxable income of $1 million, pays an income tax of $350,000, which leaves the corporation with a net profit after tax of $650,000. In scenario 2, the US company has a group of smart tax professionals, so it engages in international tax planning and sets up a CFC in Hong Kong. So the same as before, taxable income before royalty payment, $1 million. It makes a royalty payment of $800,000 to its Hong Kong CFC, which leaves the US corporation with a taxable income after royalty payment of $200,000. And the income is subject to a 35% income tax rate, so it pays $70,000 in tax, which leaves the corporation with a net profit of $130,000. And let's look at the Hong Kong side. So its income is derived from the royalty payment it received from the US, but Hong Kong is a tax haven in which there is no tax on foreign source income. So Hong Kong CFC pays 0 tax on its $800,000 of income. So by engaging in savvy tax planning, the US corporation in scenario 2 was able to save a whopping $280,000 in tax, which is a significant chunk of money. So when President Trump came into the office in 2017, he saw what the corporations were doing, and he wanted the corporations to move its operations back to the US. So he passed Tax Cuts and Jobs Act, which was the biggest tax reform in modern history of the United States. And GILTI was one of the provisions included in Tax Cuts and Jobs Act. So what is GILTI? GILTI is foreign income from intangible assets. As mentioned before, intellectual property, copyrights, patents, etc. Here is the formula for calculating GILTI. It is CFC's income after deducting expenses minus 10% of QBI. What is QBI? Stands for Qualified Business Asset Investment. It is essentially the book value of CFC's depreciable tangible property. So the idea behind this 10% calculation is that the IRS or the US is just assuming that the income that is in excess of 10% of book value of depreciable tangible property is coming from royalty payments. So let's go over an example of GILTI calculation. The Hong Kong subsidiary has a net income after deducting expenses of $500,000. Its book value of depreciable tangible property is $250,000. It paid $25,000 in foreign income taxes. The foreign income taxes is going to come into play later. So for now, let's just look at these two. Okay, so CFC's income after deducting expenses, we have $500,000, and we have to subtract 10% of QBI, Qualified Business Asset Investment, which is $25,000. So we have a GILTI income of $475,000. Now we have to calculate tax on GILTI. This formula may look scary, but don't worry. I'm going to break it down for you. It's a really simple formula. So we take GILTI, and GILTI is eligible for immediate 50% deduction known as Section 250 deduction. And after taking the 50% deduction, we will multiply 21%, which is the current corporate income tax rate as of October 2023. And finally, we would deduct foreign tax credit, which is 80% times foreign income taxes paid in the jurisdiction in which the CFC operates or CFC is incorporated. So let's continue with the example. It's the same example, but this $25,000 is going to come into play now. Okay, so we've calculated $475,000 of GILTI income before, and we get the 50% instant deduction, Section 250 deduction, don't forget. And that leaves us with $237,500. And the taxes payable before foreign tax credit is $49,875. This is $237,500 times 21%. Excuse my beautiful handwriting. Okay, and we have to deduct foreign tax credit, which is 80% times $25,000, which equals $20,000. So we do $49,875 minus $20,000. Tax due for GILTI is $29,875. Simple, right? Nobody can explain GILTI simpler than I can. Okay, so what are the proponents of this GILTI provision saying? They're saying GILTI is a very good thing because GILTI tax discourages U.S. corporations from shifting their profits overseas, as they will be taxed anyways. So what are the critics of GILTI saying? They're saying this is an unfair punishment for multinational corporations operating overseas, because even if the multinational corporations did not set up a CFC with the intention of shifting profits overseas through royalty payments, they will still be subject to this GILTI tax, because as I mentioned before, any CFC income that is in excess of 10% of qualified business asset investment is subject to this GILTI tax. And because of this additional tax imposed on US corporations operating overseas, it makes it less competitive with the local counterparts in those jurisdictions, because they don't have to pay this GILTI tax. So looking forward, what is being done to GILTI? So when President Biden came into the office, he laid out a blueprint for the policies he wanted to enact, known as American Jobs Plan Act. I hope it was one of them. I hope I got it right. And in that blueprint, he essentially said, I want to tax multinational corporations more. So he wanted to get rid of Section 250 deduction, which grants U.S. corporations with instant 50% deduction on GILTI. And he also wanted to get rid of the 10% exemption on qualified business asset investment. President Biden wanted to tax the U.S. corporations more, but fortunately, or some may say unfortunately, he was not able to enact these policies. So in this video, I went over GILTI and what the proponents and the critics are saying about GILTI and the status of GILTI. I hope you guys enjoyed it. I hope you guys found my video useful. I will come back with more useful videos, so stay tuned. Thanks for watching. See you in my next video. Bye.